While we can't decide what kind of ratio we should have for debt or equity, but do you really think we should make any big change, or the investors should make any big change to the MF's investment strategy at times like these? There is a lot of global uncertainty. We are in the upcycle right now, but we don't know how long will that stay.
Oh yes, I would rather say that the pitch conditions are not so conducive, so one needs to adjust the batting tempo accordingly, right? And having said which, I would say that I would try and distinguish between debt and equity allocations out here. First, I'll try and cover the equity portion. Look, equities are fairly expensive given the Indian market scenarios, and also that the rates are rising up. The risk premium on equity will increase gradually, which means that if your deposits move back towards 8%, 8.5%, the individual investor cannot be satisfied with a 12% return on equity. He will demand more and ask more, which will incrementally get difficult to generate given the valuations at which markets are currently, right? So that portion of money can likely move back from equity to debt if the debt rates keep increasing. If deposits and fixed income securities become attractive, then money will move likely towards debt. So on the debt side, one can take two views out here. Either one keeps the money at the very short end of the curve, which is into ultra short instruments or money market instruments to avoid the interest rate risk, right? The yields have gotten fairly attractive out there. You are making almost YTMs of 6 to 6.5% at the short end of the curve. And the other view could be that my money is for fairly long term, which is, let's say, 3 years and beyond or 5 years and beyond, right? On those scenarios, one can consider target maturity funds, or which are also called as roll down funds, or they work more like open ended FMPs. The interest rates or the YTMs out there are fairly attractive, again, within a band of around 7.5 to 8 odd percent, depending on what tenor do you go for. But those are good instruments to take with a more likely scenario of getting those kind of yields and a good advantage of indexation as well on the tax front. So that's on the debt side. On the equity side, look, Sonal, I think again, I would rather say that if you want to take aggressive equity allocation, then go with large caps. Be in the cushion of large caps right now, because in times of any correction, large caps are the ones to bounce back the fastest and perhaps will give you some cushion to your portfolio because of the overall liquidity in the market on those stocks. And on a moderate side, I would recommend a balanced advantage fund or a multi-asset fund, which will give you a balanced flavor of both equity and debt. And the multi-asset could give you some additional comfort of getting in commodities as well on the portfolio side. So that'll be my current asset allocation or current changes in the portfolio. Sorry, depending on the way the markets are currently stacked up.